Day trading rules for rookies. There are rules for every game, even day trading. If you are a new player, you must be mindful of the basic set of rules. These rules are certainly not binding, but they can help you to make some crucial decisions and give broader guidelines. Knowledge is power. Knowledge here includes information about the basic trading procedures and tools, information about stocks. You plan to trade like company financials, reports, and charts, knowing the latest in the stock markets, keeping track of events that affect stocks, etc. Day trading can become more difficult and risky in the absence of knowledge. As a rookie, do your homework. Make a list of stocks that are on your wish list. Keep yourself informed about the selected companies and general markets. Scan a business newspaper, and visit reliable financial websites regularly. An informed decision is a better decision. Being realistic about profits is important. As you gear up to trade, make sure that you don't lose out on decent gains in the greed for more. Markets are tricky, and it's better to settle down for a smaller profit than ending up losing heavily. Don't regret losing out on a chance. If required, you can always buy the same stock when it dips. Every small profitable trade will help boost your confidence and also give you a chance to try out the strategy again. Trading on margin means that you are borrowing money from a brokerage firm to trade. When appropriately used, margins help to amplify the trading results, but amplification is not of profits, but of losses, as well if a trade goes against you. As a rookie, keeping control of the amount of indulgence is vital, and trading with cash in hand helps to achieve that. To begin with, indulge in day trading without using margin. The high margin requirements for day trading on margin also act as a barrier for many to trading on margin. Day trading rules may be different for each trader, but controlling emotion and limiting losses are necessary for any strategy. Beginning traders should trade accounts with paper money, or fake trades, before they invest their own capital. However, adjusting a strategy as time goes on and the trader becomes more aware of the market is equally as important. Knowing the price at which you wish to enter at an exit can help you book profits as well as save you from a wrong trade caused by unnecessary confusion. Don't play it by ear. You must have some pre-fixed levels in your mind for every stock you plan to trade. In case the markets are not favorable, exit to cut losses. As a beginner, it is advisable to focus on a maximum of 1 to 2 stocks during a day trading session. With just a few stocks, tracking and finding opportunities is easier. If you simultaneously trade with many stocks, you may miss out on chances to exit at the right time. Many orders placed by investors and traders begin to execute as soon as the markets open in the morning, and thus contribute to price volatility. A seasoned player may be able to recognize patterns and pick appropriately to make profits. But as a novice, it is better to just read the market without making any moves for the first minutes. The middle hours are usually less volatile while the movement again begins to pick toward the closing bell. Though the rush hours offer opportunities, as a novice, it's better to avoid that time to trade. Day trading is risky, and there is a high chance of losses. As a rookie, set aside a surplus amount of funds that you can trade with and are prepared to lose, which may not happen while keeping the money for your basic living, expenses, etc. This will ensure that you are not increasing the risk quotient by neglecting your day-to-day needs while day trading. Above all else, day trading requires your time. Don't consider it as an option if you have limited hours to spare. The process requires a trader to track the markets and spot opportunities, which can arise at any time during the trading hours. Keep away from penny stocks as a beginner in day trading. These stocks are highly illiquid, and chances of hitting the jackpot are often bleak. Don't trap yourself in a trade that is difficult to exit. When you place a market order, it is executed at the best price available at the time of execution. Thus, there is no price guarantee in a market order. A limit order, meanwhile, does guarantee the price, but not the execution. Limit orders help you trade with more precision, wherein you set your price not unrealistic but executable for buying as well as selling. Don't trust any SMS, mail, advertisement, etc., which makes claims about above normal profits. It's not that all such sources are bogus, but authentication is required. As a rookie, be sure not to be tricked by someone lands you with a bad trade for a commission. There are times when the stock markets test your nerves. As a day trader, you need to learn to keep confidence, greed, hope, and fear at bay. The decisions should be governed by logic and not emotion. This may be hard for a beginner, but only someone who can learn to control his or her emotions can be successful. Before plunging into the real-time arena, it can be a good idea to try a simulation exercise. Investopedia has a stock simulator here. Day trading requires time, skill, and discipline. Skill is developed over a period of time as you participate in the markets and trade with discipline by devoting your time. A sound understanding of some good day trading strategies can provide a foundation for this endeavor. Self-learning is the best way to learn, and as Jesse Livermore, a legendary trader, said, "I know from experience that nobody can give me a tip or a series of tips that will make more money for me than my own judgment." How to optimize your trading performance. This is the age of retail investors, and India is not immune to the global trend. We can prove it with numbers. Retail investors' share on the NSE alone increased from percent in to percent in. In June, the number of new investors registered on a monthly basis reached an all-time high of million. Individual investors are increasingly turning away from conventional safe haven assets like gold and real estate, as well as bank deposits. While this isn't the first time India has seen a retail investment boom, it is the first time that these first-time traders are coming from beyond the metros like Delhi and Mumbai, and from the country's smaller towns and cities. They are even defying conventional wisdom and willingness to go against conventional trading strategies. Many new traders have embraced stock trading for a variety of reasons. The pandemic undoubtedly fueled the surge in interest. Millions of people suddenly found themselves with greater money and more free time. The prevalence of easy-to-use investment apps, which are progressively being incorporated into payment apps, making money transfers even more simple, fueled the unanticipated retail investing frenzy. These tendencies have been building for some time, but their influence has only recently been apparent. Some of the reasons for first-time traders to start trading include greed, FOMO, fear of missing out, hope, frustration, and boredom. While trading in the financial markets is fascinating, exciting, and gripping, for some people, trading, with its promise of great income, financial freedom, often frenetic pace, highs, and lows, can become an addiction, similar to alcohol or gambling. Whereas some average investors might strike it rich, for most people it can cost them socially and economically. Just as the saying goes, too much is too bad. Isn't it? But what defines too much? Is it the capital? Is it the number of trades? Is it the trades in the same script? Or anything else for that matter? A typical trader whilst seeing the charts knows admittedly how the mind races to take trades. Going long, short, hold, squaring off the position are the most common calls the mind screams and a trader is driven by. And the only way to know the performance is by the profit-loss statement. But this only states the performance, and fails to improvise the trader. Now what if the trader wants to just check which trades taken were in favor and which were not? How long the trades were held and what happened after the exit? At what time of the day the trades were generally successful? On what days the trades were successful? How often were the trades sold in panic? What is the suitable risk appetite? In India, most of the first-time traders in the year were influenced by the traders who showed screenshots of their profits on social media platforms like Twitter, YouTube, and Telegram. People just saw their profits and jumped into the trading, either copying their trading calls or being dependent on random calls they received from various sources. A few traders decided to take lessons from professional trading academia, and a few just learned by committing several mistakes on their own. They chose to march on regardless of the road until they all suffered significant casualties. Many of these people left the journey knowing that they couldn't take any more losses. On the other hand, the number of people who joined this ever-changing wheel of trade continued to grow at an incredible rate. YouTube, Twitter, and Telegram have all played a vital role in this rise that cannot be overlooked. All of these platforms, if you look closely, have one thing in common: financial success. This generation is influenced by the massive profits made by the chosen few on these platforms. FOMO, fear of missing out, triumphs over logic and rationality, encouraging new traders to make money by following the chosen few on these sites. They make money one day and lose money the next, which is perfectly normal till the whole invested capital does not vanish. Although some people opt to give up in the middle and others decide to borrow more money from their loved ones to cover their losses. They lose more in the process of recovering, and they realize this is nothing more than a risk. There is no way to define the real success metric of the select few, that they are genuinely doing good. Their results, profit or loss, are not just due to luck but sheer knowledge and skills that empower them to do wonders. There is no way to rank these traders in a way that would not just define their profitability but their behavioral and technical skills coupled with knowledge about the markets. The ranking metric is not just applicable for the select few, but also for every trader to motivate and know how good they are with their skills and knowledge. While in this day and age, there are plenty of platform tutors who educate about trading and making profits, but until recently there was no way to find a trader's success other than his P&L statement. No tools that were available in the market to define behavioral traits of the trader based on the trades she took, and there was no platform that existed that could predict what strategy a trader used. On this front, the Indian stock market has witnessed the arrival of a new platform by Anastrat to help traders analyze their trading behavior and maximize profits. This platform is beneficial for those traders who have less time in today's fast-paced world. It provides post-trade analytics that helps traders zero in on winning strategies and avoid losses.